Love that music. Love that countdown. What's up, everybody? Welcome to What the Fick? What the Fick, man? Spencer Israel here with the Ian Cully, head of Fick at All Star Charts. Mr. Ian Cully, how are we doing today?
Excellent, Spencer. How you doing?
I'm in a great mood because it's Friday, obviously, and we get to talk bonds, rates, yields, macro. That's the theme of the day. We've been talking about commodities for the last couple of weeks, Ian. I need a break from the commodities. Okay, I need a break from that. So
We'll
let's
we'll
talk.
definitely mention them today. We'll mention them.
Oh, we will. Okay, fair enough. But let's talk about fixed income. It is part of your coverage area, and we've had some interesting developments in the past few days and weeks, for that matter. So let's bring a few charts up, and then in a few minutes after we go through the charts, we're going to bring on today's guest from Against All Odds Research. So let's do that in a second. But let's start with the charts and tell us what we're looking at here,
Well,
and let's just rip through the state of the bond market.
yeah. So first off, you can't really. I think we can have a conversation about bonds without talking about the dollar.
Mm.
And the reason is that the two have just been tracking each other, rising and falling in tandem for the past couple of years, and that really picked up in the spring of last year as the Fed kicked off the tightening cycle. Now, dollar broke down below a key level, undercutting these prior peaks, 2016 and 2020. And now it's looking like it might rebound. We might get a failed move here, and it would make a lot of sense to see a stronger dollar as rates continue to rise. And that's really the state of the bond market right now. As bonds continue to roll over, the trend remains to the downside for U.S. Treasuries, and those interest rates on the flip side, continue to rise. So it would make sense to see the dollar catch high here. So the big question I have, what does that mean for risk assets? What does that mean for stocks? What does it mean for commodities? But first, just check out rates. 5-year, 10-year, 30-year, these weren't topping formations, right? Digging in at those pivot highs from last summer, and they're all starting to press towards fresh highs. And this is what I see when I look at the 10-year yield. One upside resolution, followed by consolidation after another upside resolution. Question is, are we going to get a further upside resolution here towards 5.25? I think we do. I think that's the path of least resistance. But of course, I'm going to see those new highs. Let's see those new highs in the yield before we can really get behind that, before I can get behind that. But of course, you got to understand the environment that we're in when it comes to bonds. As JC's been pointing out over the past couple weeks, positioning stretched. Positioning is certainly stretched. Large speculators, reaching record level shorts here in the 10-year T-note futures. But Ian, it's an important data point. We got to remember, price comes first, and this is more of a sentiment indicator. It's more of revealing the environment that we're in. Bonds are stretched to the downside, but we look at the charts. They've really been going nowhere for the past almost 10 months, working on a year here. They've been consolidating within what I see as an ongoing downtrend. So, we can get short the 10-year T-note on a break below 1013, 1015, heading back down towards 105, 104 and a half, with the understanding that, there's stretched positioning. We are, entering an environment where conditions are set for a potential squeeze in bonds. I don't think we're going to get it. But I think the most important thing as we look, forward into the back half of the year towards December isn't necessarily if rates rise or if we just experienced a failed breakdown on the dollar. I think it's more about how these moves unfold. how does the 10-year get to 5.25? What does that move like? Is it a ripper? Does it just charge up to 5.25? I think in that environment, stocks do not do well. And that's really what this chart here highlights. This is a bond volatility index, the move we inverted. So whenever bond volatility, is spiking, it's not good for stocks. Here we invert it. So as the line rises, bond market volatility is decreasing. And in that environment, stocks do really well. Stocks want to be the star of the show, Spencer. They don't want bonds over there getting all the attention, causing a ruckus. It's just not a good look for the stock market.
Yeah, what's funny is all this attention being paid to high yield savings accounts and fixed income, the start of the year for the first time in Lord knows how long. And it turned out, yeah, rates are elevated, but the stock market is doing even better. So
yeah, absolutely. And it's really, that's a great point. And I look at the sell-off from last year and the bottoming that took place in late fall of 2022, and that has resolved higher this year. I just see that as a potential reset. We entered a new regime. We entered a regime where rates and the dollar are rising together. And look, commodities took off in 2022, even in 2021, back half of 2021, as the dollar was rising. This is generally a strong negative correlations between these two assets.
Hold on. So this chart, this is just
not the case, because we're moving into a very different environment, a rising rate environment, and I think that the market is resetting, and it'll be very interesting to see how things unfold in the back half.
Yeah. So wait, this chart's just showing the dollar index against the broad commodity index. Yep.
Absolutely, against commodities, just the broad commodity index. Yes, absolutely, CRB index.
Yep. All right. Ian, I could ask you questions myself, and I have a few, but rather than me do that, why don't we bring on today's guest who can actually who's much more informed about these things than me, Jason Perz from Against All Odds Research, friend of the program. Let's get him on right now. Jason, what's going on, man?
Hey, not much. Just listening so far. Good stuff. I love, the fixed income space. I love the fixed income space. It's something that when I first started trading, I was all about it. That's everything I needed to learn because it's so correlated to the rest of these markets. So, I just love what you guys have done so far. Love this chart especially. It was interesting. Q1 of 22, and Ian and I were talking about that at this time. I had so many people blowing me up during Q1 about my crazy long positions in commodities. You're insane. They're gonna die. You're crazy. And then the Russia situation happened on top of it, and then it all moved up. And so I think the one thing that's always important when you show a chart like this is sometimes the price action is going to dictate everything. Mm. Sometimes you're sitting there looking at it and going, this doesn't make any sense. I don't know why I'm long these things. But the price action has dictated that you should be long those things. Sometimes it's okay to be long those things and also long the dollar. Sometimes you're going to be long things like that, and it's not going to make sense in your portfolio. But really, at the end of the day, I love when situations come up like that because now you have a hedge in your portfolio. You're long these commodities. It's going to probably shift at some point, and then that dollar trade is going to take over. Then that's making money while you're next thing you know, you're shorting these commodities. I mean, there's a method to the madness here. So I like this chart.
Yeah, I love the point you just made. I heard it the other day. I can't remember what podcast I was listening to. Sorry, but the price action, the point they're making is price action dictates the narrative. Mm-hmm. It's not the other way around. And we're seeing that. So
that was from the morning show this morning, I think.
Was it?
Yeah, I think so. But we were talking about crypto, I think, in the context of that comment.
Yeah. Yeah.
Yeah.
I do my best to catch it live. Often, I'm trying to
Yeah.
write in the morning.
Yeah.
And I'm one of those guys, like when I grew up, I couldn't do my homework in front of the TV.
Oh yeah. Same
I
way,
just
man.
I just I just couldn't do it. I had friends that, I'd go over and they've been watching TV and they're doing the homework. I was like, how they doing?
Likewise. Likewise. Jason, what is your take right now on the charts that Ian just shared? Not so much the commodities per se, but bonds right now.
Ian, can we go back to some of those charts? Yeah, there we go. Actually, use the COT one.
Yeah.
So I love this one, and the one thing that could be added to what you said is when you're looking at this and people see extreme positioning. I always say, like, I use COT data. Like, I have an algo that uses it. Like, I love COT data. I have many systems built on it. At the same time, I know that I've never entered a position based on just the COT data. So we're seeing commercials. This is the smart money. So when people teach this, sometimes they teach it wrong. They think the hedge funds are the smart money. Hedge funds are not the smart money. We're the dumb money. The smart money is the people who actually are behind it, the producers, especially when you're looking at something like gold. Think about, they're seeing how much money's coming into that market, how much demand is going on, how much supply they have, and so on. So these are the commercials. These are the people we want to be involved with. So when we're looking at this chart, the other thing that's interesting is seeing that you're pointing at these highs, the green circles. At the same time, none of it just turned around right there. People see like, oh man, if you bought around there and held it here. No, think about it in a little bit different than that. There was a new low to look at 2018. And I remember this because there was extreme positioning. This was in August and September. There became this extreme positioning in bonds. But they ended up going to the downside one more time. And it was a pretty sharp decline. Gold had a sharp decline. It also had extreme commercial buying at that point. So there's a sharp decline there. So then people came in, and then you started to get buy signals into the later stage into the year. I think that was into November, started to turn around. Then you started to really break out into that next year, into 2019. So something that should always be added when you're looking at or putting on a bond position like this and using the commercials is you have to look at that and go, wow, like I'm looking at it right now and going, wow, that's serious. But breaking up over that 118 level would be significant, and then that would be a buy signal. This isn't a buy signal by itself. That's a buy signal. So you combine these two together and you get a very powerful system.
This is the difference between 2018, that this is the bottoming process in 2018 that you were just talking about. And this is kind of what momentum and what price were revealing at the time. You get an overbought reading, bulls take control of the market. You get an oversold reading. There's this kind of tug of war as price bottoms, but then bulls gain control, and look, we get a strong uptrend. Now, looking at the chart today, bulls simply haven't showed up yet. So until they do, I guess there's really nothing to do here except get short with the understanding, of the positioning landscape. I mean, that's how I see it. Are you what's your position on bonds right now?
Right now it's still short the 2-year.
Okay.
And that's about it. Right, everything else has turned flat at the moment because it's just chopped. There's nothing else to do. Go back to that chart in 2018 again. I had one thing to add.
Do you remember short the 2, Spencer?
But so when you're looking at this and you're looking at this bottoming here, the bottoming process, everybody loves to buy the bottoming process. It's all people talk about. You got to buy the bottom. It's fun, catch the bottom, but real traders, they talk about it in a different way. That's catching a falling knife. You're going to get your hand chopped off. You can't catch a top, you can't catch a bottom, try to catch the meat in the middle. That's the real secrets of trading. But if you're looking at this range here, we got to put ourselves in trader's psychology. That market was in a downtrend for a very long time, just like we're in today. What happens when you're in a downtrend? Well, people get in despair mode. People, are very quick to buy and go, oh my gosh, it's a bottom. And then the second it ticks up and they see a little bit of a sell-off, they start selling like crazy. So this is what creates those ranges. They see a level, then it starts to build that level. Can't get above that level. Then we start to get above and consolidate above that level into 2019. Now we're seeing some strength. Now that's created a great trend into 2019. We consolidated up there. So, don't be so hasty to always buy things when they're ranging or when you think there's a bottom. Be more interested in waiting patiently, sitting on your hands. I call it like going fishing. Like you got your bait in, you got your lures in, you're sitting there, you're just enjoying the day. And then when you get a signal, a little tug on the line, then you jump in. Now you jump in, now you put the trade on, boom, there you go. But doing it just in a way that's like, oh, well, I don't have any signals, I have nothing, and I think it's a bottom, that's a guess. And hope isn't a trading strategy.
No, it definitely is not.
So go back to today. Ian, please. So looking at today, now we're, like you said, we're in a range. Now, range traders could trade this in a different way. They could go, okay, this is kind of a range bound market. I'm looking at this 110 level here. I'm going to trade it to that 117 level. As a range bound trader, that's a possibly a good trade. What some range bound traders would do that I worked with for many years would wait for something like a 10-day exponential moving average. Once it gets above that 10-day, they would buy. Because you never want to buy just a bottom. You want to have a little bit of momentum behind it. So as it moves up to that 117 level, now we're going to just let it hit that, see if it goes above it. But if it gets below that 10-day again, you want to get out of it again. So you could look at a trade that way. Or if you're a long-term trader, you could look for that breakdown of that 110 level like Ian talked about, or you could wait for a breakout of that 117 level. So there's kind of 3 trades to do here. It's not even a sit on your hands. It just depends on what type of trader you are.
Absolutely. Different strokes for different folks, for sure. I think,
I want to get, I'm sorry, Ian, go ahead. Finish the thought.
No, please.
Well, I want to get to some adjacent charts that he brought our way. So I know where you want to start here. I mean, we have a sector chart. Jason, I'll defer to you.
Mm-hmm. So this sector chart, so what basically I wanted to talk about was three different things that might be significant in these markets. And sectors to me are always the most significant if we're looking at the S&P 500, trying to figure out which way we want to go, how we're going to be positioning ourselves. And so as traders, we always want to be in strength. Relative strength is the most important thing in markets. I've talked to people and debated people for years, and tons of people, fundamentalists think it's, crazy because they want to buy things that have extreme value. For me, I'm trying to outperform the S&P 500. If you're not outperforming, there's no reason to be trading. So as an outperformer, I'm looking where the strength is. So what I'm looking at and what we're talking about here is kind of into the back half of the year. Where's the strength and what's ticking up and what could be positions that I'm going to want to be in? Now, energy is at the bottom of this chart. But if you looked at one that was a little bit more short term, you're starting to see energy tick up and come in again as being one of the stronger sectors. So things like energy, oil, I'm starting to really look at those things and go, okay, well, as year to date, and this is how all these things work. I talk to people all the time about this and they go, why don't you just, I have, and Ian knows, I have long tech trades, long semiconductors, long home builders, long anything, basically all the tech sector at the moment, because all of them have buy signals. But I'm starting to get buy signals in those energy sectors and those oil sectors. So as we're seeing that, now I'm going, okay, well, I don't know where the market's shifting. Does that mean I'm going to sell the semiconductors? Absolutely not. Does that mean I'm going to sell home builders? No, none of that. But I am going to start taking into consideration that the market could be shifting into a different regime. I'm also seeing signals, and on the next chart, Ian, you'll see another signal I'm getting at, which is the energy sector. So this is the CRB index against bonds. So when we're looking at the CRB index against bonds, that's always very interesting to me because it can tell you a lot about how people are positioned. Commodities aren't something that people are always positioned in, but they run the world. So the price is always moving and people are hedging themselves and buying. So once again, now we're in this situation where we started to see bonds possibly take this over. It got below that 200-day. Started to get into the cloud support. So it really wasn't saying clearly move one way or the other. It was kind of just saying, hey, we're sitting here, we're flat, we don't know what's going to happen. And at that point, once again, it's another sit on your hands. But now it's above that cloud. It's above that 200 day. It's starting to move to the upside. Now I'm getting pretty interested. Now I'm looking at this and going, oh, that energy sector is looking pretty good. OIH, the oil services sector is making another high, like, so add those things together. Now we're getting a very powerful signal. And this is a thing that, you guys do great over here at Stock Market TV, is you guys are always looking at confluence of signals. Some people have one signal, some people have two, some people don't have any, they use fundamentals. A confluence of signals, now that's a powerful thing, because we look at intermarket analysis, we look at commercials, we're looking at the charts themselves. Now the charts are given buy signals, the intermarket analysis is starting to give buy signals. So you put all that together, I could see that energy might be a place to be going through the summer and to the end of the year. But also I'm saying, looking at the sectors, I don't want to get short tech. I don't want to get out of my tech positions. I'm going to be staying long those as well.
Absolutely. Absolutely. It's that top-down approach. And, last week in the commodity post, I kind of started at the top and gave my thesis on why I really like energy. And if I didn't include the CRB bond ratio, I know I have at some point in the past few weeks. I'm looking at XLE relative to tech. I think digging in at a potential level of support. I think that's a really important chart to look at from an intermarket standpoint. But later today, we're gonna put out a post where I dig into the actual individual names, because seeing a lot of oil services names. I think that's the strongest sector right now. You just mentioned OIH. XES is another ETF that looks great. Schlumberger is looking good. It looks like it wants to break out. So yeah, that's what we're gonna dive into. And I really like the energy space right now. So definitely.
Jason, I would love to get your thoughts on the events of yesterday. Bank of Japan with I guess coming out with a surprisingly hawkish announcement that they were going to increase the ranges on their yield curve control. I don't know if you want to even explain what that means, but regardless, markets reacted negatively to that. We also had our Fed meeting on Wednesday, which was a bit of a snoozer, but the markets there they were the next day. I don't want to selling off is a strong word, but at least not going up, right? Going down. So what is your take on just the macro developments from this week and how it relates to the bond market specifically?
Yeah, so especially the Fed day. We'll start with the Fed day. So the Fed day for me, I'm always watching, I'm paying attention. Fed speak also is a different language, so most of the time I could watch the market and watch it in silence and just kind of see people reacting. Sometimes that's fun. It's a whole fun game that the Fed speaker do. I love to read the actual report. That's something I suggest everybody do. That's something
it's brutal. It's brutal.
Yeah, the noise is kind of turned off, like that's the best way to do it. But when you're just sitting there listening to him and he's getting, structured questions, it doesn't really do much for me. But the way I would, like you said, it was muted. I have a chart up here looking at the NASDAQ right now. So, it was a completely flat day on a Fed day. And not to mention, the report came out, the market didn't really do anything. After the report came out, he's talking, the market's not really doing much. That's new for a Fed day lately. It's been pretty eventful lately, but they had it really priced in. I mean, this was the first time I looked at it, weeks ago, and it said over 90%. They knew what they were going to do already. So I mean, it was done, and people knew it. And so we had this Fed day, but once again, the next day gets really crazy. So what I always tell traders, and especially when I was more short term, is that when you're looking at the Fed day, the first day, nobody has any clue what's happening. Traders are just reacting. Someone's probably making money off the volatility. I knew plenty of traders who did that on that day using things like iron condors and so on. That's a good trading strategy during those days, or just spreads in general. You have a lot of volatility before the event and low volatility after the event, so you can make some quick cash like that. And then the next day, happens, and then you see kind of a move that makes no sense. The market will go up, it'll go down, it'll go sideways. People just kind of freak out. And that's usually just a false move. I've seen it a million times. It's usually just a bunch of panic. On the third day, that's when I start to go, this is the direction we're headed. I'm not, once again, I can't know anything for certain, but most of the time, the direction we head on that third day is the direction we go for the next couple of weeks. So I could see this as an update being a very positive sign and a bullish sign for the market. On the Bank of Japan, they're always they're usually always dovish. So to the most people, that would be like kind of a hawkish thing. But for me, I'm kind of like they have to do something. They're not doing anything that any of these other countries are doing. So they're kind of doing something to make it look like they're protecting their currency, so other investors continue to come in. And so most of the time you'll kind of see that happen with Japan. I really, once again, it's kind of like watching their currency, and they're always talking about protecting their currency. But at the end of the day, like, I think they've done one of the worst jobs trying to protect their currency, but their currency is still holding up pretty decently. So, it's been an interesting week in the macro space.
Absolutely.
I don't even know how to interpret these events, because I gave up on trying to speak Fed or understand Fed speak a long time ago, because it goes over my head. So I just like to look at how the market reacts. So on that note, Jason, you said look for the third day after the event. Well, that would be today. Yes. And I'm looking at stocks, and they're up. So according to you, that would indicate that the path of least resistance for the next few weeks is higher, at least in stocks.
Yeah, I fully believe that. And I think that, most traders get so bogged down into what is said and what was done, and were rates raised or were rates not raised, or cutting or not. Everybody was looking all year long like, oh, they're going to stop raising, they're going to cut. That's why the market's going up. It's like, you can't predict what the Fed's going to do, but you can go, everybody's pretty bearish. Everybody is thinking bearish. Positioning is very, very bearish most of this year. Now it's starting to change, but most of this year it was bearish. So looking at all that and going, okay, well, the market's been going up and the Fed's been raising rates. There's a very interesting study of just going like, okay, if I just, make a basic trend model and say, if the Fed's raising rates, I don't buy stocks. If the Fed's lowering rates, I do buy stocks. And so looking at a study like that, you would filter yourself out of the trade this year. There would be no trade this year. You wouldn't be able to go long. So like you said, the most important thing, Fed speak is Fed speak. Nobody knows it on purpose. It's a whole different language on purpose. But what we can see is the charts are moving up. The charts have been strong. We do see some rotation into certain areas. We are seeing commodities really pick up again. So we're starting to see all of these things kind of pick up together, and bonds are flat. So there's nothing to do, but maybe that changes. All of these things just add to this, basically the macro space and the cycle of what we're looking at. That chart you have up right now is the chart of the major cycle and the global macro cycle for me. And, I'm a big cycle guy. I've always kind of been into that. It kind of just helps me to know what I'm looking at. And so what I'm looking at here is, commodities are still the primary trend. Commodities are still the primary trend against the NYSE, against gold, against bonds. They're still the primary trend. We did have a reversal. We've seen that for most of this year, but will that change again? Will commodities take back over soon? It always can. The primary trend is always the most important thing to watch. So, to the end of the year, I'm looking at the energy space. I'm very interested, but for right now, it's a great time to be long stocks and not question it too much besides that.
And so what's the overall, what's the story what's the narrative we need to know? Bringing it back to bonds for a second. What's the narrative we need to know about bonds right now? Just stay away.
No, I wouldn't say that. So I would say I would be very open to a breakout to the upside. I would be very open to it. The downside is going to probably be limited at the moment. I hate to say that as a trend trader or a person who's even short the 2-year, but once again, I know that it's limited. It's okay to think that. It's okay to know that. Positioning being as extreme as it is, I think the downside is limited. It's possibly going to go a bit more, but it's limited. So I would be interested in, if you're a long-term investor, you're trying to put money into something, start looking at something like bonds, but wait for a signal, wait for something to happen. But I think the overall narrative on bonds are just, like Ian said, sit on your hands. But once again, it's a downside's limited. I'd be ready.
So if the downside's limited for bonds and rates top soon?
Probably. I hate, once again, prediction is tough, and it's mainly my ego who likes to predict, but he also enjoys it. So, but once again, it's I do think that that's getting closer to a top than a bottom. I do think that with the way the Fed is, they always kind of get behind the curve, right? So if we're looking at the Fed and we're going, okay, the Fed is raising rates right now. What did they do before they started raising rates? Well, inflation was transitory. It didn't even exist, really. While we're all sitting here watching all of our prices go up, like that doesn't make any sense. And we're all in these commodities trades that have been crazy. So, they continued to say that the whole time, and then finally admitted it was real, finally raised rates. I would think the Fed will get behind the curve just like normal here. They'll get behind the curve. They'll keep raising rates. Maybe, that could be something that happens. But I think that what I really believe is that they're going to stop raising rates soon. I believe that inflation will then take off again. And then they will try to catch back up. I think they will get behind the curve just like they do normally, like in 2020, like we talked about. And then I think that they will try to catch up again later. So I think they're going to talk about pausing or something. And I already see all this inflationary stuff turning up, because we as price traders will see it before anybody else in the world. And then, maybe they talk about pausing, and then it really cranks up. And then they're going to have to raise rates again. Wow. So I think they'll be behind the curve. I think that's what energy is seeing and what the commodity space is seeing right now.
So what do you think? Gold, new all-time highs before the Fed starts hiking again?
Gold is a quite an interesting one, huh? I would have thought it was going to hit all-time highs very soon. I still think it's going to hit all-time highs. I fully believe that it's going to make one more big push higher real soon. I think it's got to break out of that range very soon, and saying something has to happen, we're looking at price action is bad. But if I was a trader, I would be putting buy stops, ready to buy that, buy signals, whatever, however you trade, ready to buy that breakout, because that is going to be one wild ride. It is consolidated for a long time. It's a huge cup and handle pattern. That's going to be one wild ride, probably straight to 2,500, 3,000 even.
Fast.
Mm-hmm. Fast. Very fast. Very fast.
Can you imagine the outrage of investors who just can't wrap their head around gold catching higher as the dollar remains buoyant and rates elevated?
It's been a long time, man.
You're gonna go crazy.
Yep. I mean, it's I think the thing people don't really think about gold is, like, gold isn't something that's going to make you rich overnight. It's a good store of value. It takes a long time. It kind of diversifies your portfolio. But sometimes, man, gold and silver can make some major runs. All commodities are trading vehicles. Yeah. You can make some big moves in the commodity space. You make some big money in the commodity space, but it is a trading vehicle. It is not an investment vehicle. So be ready for it to break to the upside, but don't expect it to move straight up for the next 20 years like stocks or something.
Right. Yeah,
that's a great point.
All right, that'll be it. Jason Perz is our guest today, Against All Odds Research. Jason, always a pleasure, man.
Hey, thanks for having me on. As always, it's a blast to hang out with you guys.
All right, that'll be a wrap for What the FICC. We'll be back Wednesday. We're on every Wednesday and Friday at 11:30 a.m. Eastern Time. Ian Cully, any final thoughts?
Nope. Get out there, enjoy the weekend. Go see a movie.
All right, have a good one, everyone.